welcome to the Index Investor. Today we're talking about a product that's becoming more visible but still feels a bit mysterious for many investors. ETFs or exchange traded funds. To help us decode the ETFs and to understand if they're any different from the index funds, who are they best suited for, and much more, I'm joined by Abhishek Sipani. He's founder and director at Jericho Ventures. Welcome, Abhishek.
Hi, Shreya. Thanks a lot for inviting me.
Good to have you here. Let's begin with the basics. If you can start with explaining what exactly is an ETF, how is it different from a regular index mutual fund, or are they just both passive products doing the same job?
To begin with, I'll say ETF is a financial instrument which, like a passive fund or an index fund, tracks the underlying index, or maybe an asset, or maybe in globally we have seen a basket of stocks. The real difference is in an ETF you have to purchase the same over the stock market or the stock exchange. So that's the difference. The index fund needs to be bought from the mutual fund. The ETF is you generally needs to buy an ETF from the stock market.
All right. So, would it be fair to say that ETFs are just index funds with a different wrapper?
That's right. It's same. The operationally it's a bit different. So because you are buying it on the stock market, generally we have seen the cost of an index fund and the ETF cost is a bit lower than an index fund because the operational expenses are a bit on the lower side. That's the difference. But if you see the underlying way it tracks underlying index or a basket of stocks, it's similar.
Now, let's move on to the mechanics. If I want to buy or sell an ETF, how does it actually work for me as an investor?
So to buy an ETF, you need to have a broking account with any of the brokers. You need to have a demat account. It's just similar of buying a stock. So how you go and buy a stock, you would similarly you go and you ask your broker to help you buy an ETF.
There's this perception in the market. People say that ETFs are really for traders or short term players. Is that fair, or can a long term investor treat them just like SIPs and index funds?
See, the reason so ETF, as you said, it's similar to index fund. So any investor can buy and hold it for a long term because you're just buying it and you're holding it in your demat account.
Mhm.
The reason people have this conception of having it from a shorter term, in India, people are like when they want to buy something in a stock market, there are very few investors who think of buying something for a longer term perspective. So that's the perception. Like that's the reason you see in India so much money is traded on in the option side or intraday. So people take it as a short term because they see it trading in the market. But it's similar. You can hold it, buy it, and hold it from a longer term perspective. But one thing which is also a retail investors finds a bit difficulty, if you're buying a Nifty 50 ETF, it's easier to discover the price because ultimately in a stock market, the price discovery happens because there is a supply demand. In case of ETF, apart from that Nifty 50, there is a supply demand mismatch sometimes happens. So your slippage cost, the spread between the demand and supply may increase. Also, you may find it difficult what is the right price it is trading at. So we had seen during COVID times suddenly like the ETFs were trading at a very different pricing but to the underlying price of the index or the index that we're tracking. So that is one of the reasons retail investors sometimes find it difficult to purchase because of the price discovery. That's the reason we have not seen so much of liquidity. But I believe as the more information will be spread, will be going towards to the investors and they will become comfortable, it will be we'll see a lot of liquidity and people
Abhishek,
will
that
hold
was
it for long term.
right. That was in fact my next question, that if they're low cost and they track the same index, why haven't they become as popular? So the barriers, you said one is liquidity, the supply demand mismatch. Is there any other barrier to them becoming as popular?
There's a misconception that like ETFs are always low cost because people look at only the expense ratio, but you have to also consider other things. See, your brokerage you are paying. Now today in the times of discount broker, I believe that cost is very low because everyone like to pay a very small portion of as a charge as an expense as a broking charge or brokerage. But look at other things. the slippage cost, the spread. So when you buy something, you if there is a huge spread between the bid and the ask price, you tend to buy more higher price. So today, a lot of people may believe that ETF, but apart from the Nifty ETF, there are a lot of other ETFs. When you consider this cost, it is on a higher side.
Okay.
As an investor, what actually you're paying. So unless that demand comes up, unless that liquidity comes up, it's still like when you do all the calculation, it still come a bit costly.
Right. Now, let's talk about choosing the right ETF. If I'm an investor looking at my options, what should I really pay attention to? Is it liquidity, tracking error, expense ratio, AUM? How do I weigh these factors?
Right. First of all, if you're an investor, I think the first thing you should look as your what is your risk profile, because today a lot of ETFs are there. ETF is an instrument. The underlying, it depends the underlying asset class or the basket or the index it is tracking. So as an investor, the first thing one needs to do is like, what is my risk profile? What is my investment horizon, and where I can put that money. Once you have done that thing and you have decided I'll put in this ETF, this percentage of money, then you need to look at the ETFs. First of all, where there's a lot of liquidity, because the ETFs which have a larger AUM, which have got larger liquidity, the spread between the bid and ask will be much lesser. So you'll be end up paying a much lesser fee. If you look at the expense ratio, which the asset management company charges you, if you look at it, is more or less similar. There is not so much of a difference in that. So I always believe you should look at the underlying amount of assets, because the more the assets, you will see more liquidity, the average trading volume that happens. So it's similar to equity. So today, when you buy a small cap stock, if the liquidity is not there, when you tend to buy it, suddenly there is a demand and the prices may go up. Similarly, it happens because see the ETF, you have to, when you buy a ETF, the asset management company or the market maker need to buy the underlying stocks. So sometimes you may happen like the market maker may not be there and you coming and buying this thing, you may end up buying at a higher this thing if the liquidity is not there. So my thing will be like the first thing that you need to look at the asset size, the liquidity, which can be uh, I'll say you can check the daily average trading value volume in that ETF. The expense ratio, which I believe more or less every expense ratio of most of the ETFs are similar nowadays. There is not too much of a difference. So that should be the criteria of selecting an ETF. But as I said at the first, you first need to understand your risk profile, your investment horizon, to first see which ETF one should buy or you should buy.
Finally, looking ahead, do you see ETFs becoming mainstream in India over the next few years? And if that has to happen, what needs to change? Is it investor awareness, distribution, or the products themselves?
See, I will tell you, like I have been in this industry for the last 2 decades, and I have seen the kind of information today's investors hold. And people like you guys, like Value Research, are doing a fabulous job. So few years back, the flow of information was not there. The people were not aware. Today, with with the companies like you and other influencers who are doing a good job, the information has spread. Now, what needs to be done is some of the ETF, the liquidity needs to be increased. So I believe the market maker needs to do a better job. They needs to find out the spread is not there, so the client investor not end up buying something at a wrong price. We had seen during when there is a crisis or when there is sudden fall in the market, the price that it trades is not, it doesn't really reflect the actual price of the underlying asset. So if the liquidity helps increasing the liquidity with information flowing in, more investors will be interested. Also, what is happening, if you look at this thing, the passive investments is picking up, but still a large portion of the passive investments are done by ultra HNI family offices institutions. So when this passive investments will flow, when retail investors start investing, allocating a portion of their portfolio, similarly, a portion of that money will go into ETF. So here I believe because ETFs are traded in the stock market, the stockbroker can play a big role. The stockbroker, they can inform investors, they can educate investors, and for an informed investor or for a, I'll say, retail investor, index fund is much more risk. I'll say less riskier than investing in a stock. So I believe it will pick up. Today there is a lot of innovations are happening on the passive side, also on the ETF side. So this will help picking up the volume, and ultimately retail investors will come and participate.
Great. With that, Abhishek, time for us to wrap up this chat. Thank you for breaking it down so clearly. Thanks. So ETFs are essentially just another face of passive investing, but they work a little differently from index funds, and knowing those differences can help investors decide whether they fit into their long-term plan. Thank you for watching Index Investor. We'll see you in the next episode.